Good morning, everybody, and welcome to the final in our Meet the Managers webinars for 2023. This one is a little bit different. Rather than focusing on a particular fund manager, we thought we'd give you a really good peek under the hood so you can actually find out how we actually put together our portfolios. And to do that, because we've been working very closely with MyFiduciary, we've invited Chris Douglas to come along and give you a bit of a peek into what they do behind the scenes and how we actually make some really robust investment portfolios that can tolerate ups and downs in markets. Chris, we've known for quite some years from his backgrounds at Morningstar, more lately in terms of setting up MyFiduciary. Chris will talk a bit more about the team and MyFiduciary's track record there, but certainly in the 2.5 years since we've been working with Chris and the team, we've found it's been a fantastic outcome for our clients and therefore for ourselves. So Chris, over to you.
All right. Well, thank you, Peter, and hi, everyone. So my name is Chris Douglas, and I've got a presentation that I'm going to be taking you all through today, just in regards to an overview of MyFiduciary, who we are, and how we work with clients such as Ethical Investing New Zealand to help them develop their portfolios and their strategies, investment strategies for their clients. We'll also dig into some of the work that we're doing on sustainability investing at the moment, whether that be looking at the carbon exposure within a fund, how we think about exclusions as well. The different managers have, the no-go areas that they might have for different investments, products that they offer as well. And then we'll just finish with a quick market update in regards to how we're seeing the world at the moment, which is relatively recent. We provided an update to clients just last Friday, and I've got a few slides to share with you from that. So let's kick into things. I don't like having a lot of text on slides, and this is quite a busy slide with a lot of information. But essentially, MyFiduciary has been around for a number of years now. We're a majority staff-owned firm, so 75% of the business is owned by staff. But we're a wholesale investment advice business, and that means that we only work with wholesale clients, whether that be independent financial advisors. We also work with large charitable trusts and also large Māori and iwi groups as well. Our firm is 25% owned by the investment arm of Ngāti Tūwharetoa as well. So we've got quite a long reach into the Māori and iwi space through the work that we've done over the years. But we also service, around about half our client base are also financial advisors as well. So it's quite a broad church and an interesting mix of clients. We have 13 staff located around the central North Island, and we service around about 50 different groups, as I said, across the different entities there. Importantly, it's something that we think is really critical when you're making investment decisions, is that we seek to avoid conflicts of interest as much as possible. So we don't receive any payment from any fund managers to have products go into client portfolios. We do all our own research ourselves in-house, and we have a clear alignment around the success of our clients' portfolios, leads to the success of our business as well. We also have a lot of experience across our team, across not just managed funds, but also direct and impact investments as well, especially in the renewable energy and primary sectors too. And so indirectly, we actually advise on clients across about $50 billion. And that includes, clients who've got large allocations to fisheries, forestry assets, agricultural assets as well. Our business, the genesis of our business actually, and the reason why we're called MyFiduciary, dates back to the firm initially starting off as an investment governance education firm. And so we have a closer relationship with a company called FI360, which is a US-based global investment governance education provider. And they have curriculum that we license across Australia, New Zealand, and also into the Pacific Islands, where we teach about investment governance. what it means when you're setting up an entity, how you should think about due diligence, monitoring and the like as well. And we've long been champions of responsible investing at MyFiduciary as well. We're certainly believers that by including environmental, social, governance considerations into a portfolio aspects leads to better returns for client portfolios. We're also a member of the Responsible Investment Association of Australasia. I sit on their certification assessment panel across Australia and New Zealand, and we've made the Carbon Zero 2050 pledge as well. So before I get into, the team that we have, I always think it's interesting just to provide pictures of people, just to give a sense of the different personalities and different people that we have within MyFiduciary. We've got a large investment team here. So we've got 6 people sitting on our investment committee, and a number of other people within the firm that feed into that as well. We've got a deep bench of experience across our firm. So typically people have got around about 20 years or more experience in investment related industries. We've got people who've got large institutional experience across where they've worked at New Zealand Superannuation Fund, for example. We've got experience across alternative investment structures, as I said before, and the Pacific Islands, and also just across managed funds and KiwiSaver as well. So our team's been growing quite a lot over the last few years, and we actually acquired a small Taupo-based investment administration firm that increased the sizing of our staff by 4 just recently. Before we get into how we think about building portfolios, I think it's really important to think about some of the prudent practices that we think about from an investment governance perspective when we're working with clients and building portfolios. And a lot of these might come across as quite common, just good common sense. And in many ways, that's what investment governance is about. Having processes that are clear and transparent, make sense when you're describing them to someone else, but also ensure that you're meeting the objectives that you're setting out, so what you're saying you'll do with your clients. And especially given that when you're thinking about investments, we are really operating in a place of trust and good faith around the role that advisors, consultants and fund managers play when providing investment services to individual investors. So some of the different prudent practices that we talk about are things like the fiduciary duties of loyalty and care. And that means that in all aspects of all decision-making processes that we make, we think about the end client and the duty of loyalty to and care to the end client in those decisions that we make. I've mentioned conflicts of interest. Really important that you manage those if you have them, transparent, and avoid direct conflicts of interest where you might be remunerated to be making a decision, which is something we focus on very much. We think about our clients individually, and even when we're looking at Ethical Investing New Zealand, they're a differentiated client to many of the other advisors that we work with because of their focus on ethical, sustainable outcomes within the investment strategy. So that means, thinking about how those specific objectives and investment philosophies that they have, how that relates to the investment strategy that they employ, how we manage it. Also, we make the recommendations around the investments they should have in their client portfolios and how we do ongoing monitoring of them as well. We talk about an IPS, that's an investment policy statement. That's essentially a financial plan. Think about due diligence criteria, processes, and then finally the fiduciary file is really where you're keeping all that information, storing all that information, so that if anyone's got any questions, you can always go back and you've got a correct record, record of all decisions that have been made. So this is just a summary of some of the things that we think about, but it's very true to who we are as a firm. It's something that we focus on, and a lot of the work that we do around making sure that all our decisions are made in the best interest of our clients, and we're operating at the highest standard of fiduciary care. So as a firm, we've got a framework around how we think about building portfolios. And a lot of this comes down to the work that we've done in different guises in different places over the years. So I mentioned two of my colleagues were founding members of the New Zealand Superannuation Fund when they actually set up the NZ Super Fund, the Cullen Fund, and put in place the processes around the building blocks around how they wanted to think about true intergenerational or long-term investing. And my time when I've worked at a global asset consultant called Morningstar, again, there's a very strong academic backbone, academic rigor that we bring to building portfolios. But we like to bring that in line with just real world, an understanding of real world issues that people face, as well as thinking about local nuances that we might have from a New Zealand investor's perspective as well. But when we're building portfolios, we think of a couple of different things. We think about building a core framework for portfolios where we've got exposure to growth assets, inflation resilient assets. When we talk about deflation resilient assets, that's assets that if we've got we're in an environment which obviously we're not at the moment, where inflation's decreasing, what type of exposures are going to also benefit the portfolio as well. And also diversifying assets. What assets can play a really interesting role in the portfolio and help to decrease the volatility of returns for investors and provide a smoother outcome for them as well. So when we talk about the right balance of assets, we like to think about it around assets all playing a differentiated role in the portfolio. And this is a graphic that we present through a lot of training and investment governance workshops that we do to think about the different type of investments you might have in a portfolio. And you might start off with a taonga, not for sale or cultural assets that people might have. And if you're an individual investor, then that could actually just be the family home. It's an investment that you've got. It's worth something, but it's not something you're necessarily going to be looking to sell or trade or be able to use the proceeds quickly. But it's something that you want to be thinking about when you're building out your plan. You've got low risk cash generating assets as well that you might have, whether it be cash, term deposits, fixed interest, high return growth assets. These are the ones that are invested in direct companies, growth oriented funds, PE is private equity investments. We've got high risk, high reward investments, which is typically in venture capital, maybe property development. And then you've got assets that protect against inflation. Here we think about infrastructure-like assets. And when we think about infrastructure assets, that could be something like an airport, a toll road, a utility company where they've got pricing power. So they're typically a monopoly asset or an asset that has got strong government regulatory environment, and that gives them pricing power, especially around increasing their pricing linked to inflation. And we see that through a number of the energy companies that we have in New Zealand, would be Meridian, Contact, and the like. There's government ownership in these entities, and they've also are really important utilities and typically monopoly type assets within their region. So we want to be thinking about these different allocations and how they mix and how they blend together. And we spend a lot of time looking at the different returns that you can have through those different building blocks. So what's a plausible return assumption after fees have been paid that you can think about? Now, these numbers are, they're about 12 months old, actually, and certainly we've seen cash rates come up quite a lot. We're actually just going through revising our return expectation numbers right now. But, thinking over the long term, you can look at cash fixed income giving you, let's say, 4 or 5%. A balanced portfolio, real estate, infrastructure should give you around about 6%. More of a growth-oriented investment into the share market. New Zealand equities, Australian equities will give you more of an 8% return over the long term. If you're then buying a company directly, investing into private equity funds, you're going to expect maybe a high return of 10%. And then if you're going into venture capital development projects, you might expect a high return of 12%. Now, there is a huge amount of uncertainty around these numbers, especially over a period of 1, 3, 5 years, and even 10 years. But what we see is that over the long term, you do see asset classes provide a certain return outcome. The point that you need to keep in mind when you're thinking about return outcomes that we work closely with clients on is that we need to make sure we're being realistic and we've got a valid process around how we're developing our long-term expected returns. And the point that we also make to people is that if anyone comes to you and says they're going to offer you 10%, 12% or more, certainly above before leverage and after inflation, that's a red flag because that is taking on a significant amount of risk. And that's where we find people don't understand some of the volatility in returns that they can have, and also the risk of capital loss that they can have by taking on those risky investments. So we think a lot about returns and also risk and how these different strategies will blend and work together. And one way to think about this is to then just rank them. So we've got a range of different asset classes that we think about here. And this is going back to 2013 and looks at global equities, New Zealand dollar hedge to return 32% in that calendar year. So it was a good year for investing. Global equities was up 27%, New Zealand equities was up 18%, infrastructure 16%, global property 8%, Australian equities was 3.8%, cash delivered 2.7%, bonds 2.2%, and then New Zealand bonds and emerging markets were both negative that year. And this just shows you, within one calendar year, just the range of outcomes you can have by investing into different markets. What happens if we look at 2014? Well, global property was the best performing asset class that year with 23%. Australian equities, emerging markets were some of the poorer parts of the market to be investing into. And so what I'm trying to show you is that on a calendar year basis, you see returns move around quite a lot. And there's a randomness to it, as illustrated by this chart, which is really busy. And I don't want you to focus too much on the numbers. But if you look at the colors, you'll see the colors move around a lot. We call this the game board internally. Otherwise, it's just a ranking of from best to worst of the broad asset classes that we invest into in our client portfolios. And you'll see that you'll have some sectors which are the best performing sectors for a period of time, and then there'll be the worst performing sector. Likewise, those at the bottom can quickly move to the top. If you just look at cash over 2019, 20, 21, operating some of the lower returns, and then when we had a large market sell-off in 2022, cash was the best performing investment. And so what's really important is not just about investing into some of the more growth-oriented sectors like global equities, like New Zealand equities, where you invariably will have some strong performances coming through. But it's how you blend those different investments together. It's how you're thinking about portfolio construction in the sense that these assets will work at different times together. And we spend a lot of time trying to understand that to come up with the best portfolios for our clients given from a given level of risk. So when it comes to portfolio design and good practice, this is what we think about. First three key areas are diversify, rebalance, and keep costs low. If you just follow those three tenets, I think you're going to have, you're going to be tilting the odds in your favor towards having a good outcome and meeting your objectives. Other factors that we think about are things like chasing value, not growth. the growth will come from investing in share markets. You've got to be mindful of just investing into something that's suddenly been yesterday's best performing asset class or investment. And we see this time and time again when people see the performance of companies like Tesla, for example, like Apple, and after they've had such strong performance, they look to invest into them, and then they can often have a disappointing outcome. And for that reason, we think about being contrarian, or at the very least, don't be pro-cyclical. And that just means don't invest into what's worked yesterday, thinking about some good fundamentals and what's going to be working in the current market environment. Being disciplined is really critical. We often find that people, by chasing returns, they have disappointing outcomes. They often buy when news is, company news is positive. They hear a lot about it. They go and invest into a company, and then they sell at the bottom after they've had a disappointing outcome. So being disciplined, making sure that you're holding your investments through time, we think can give you the best opportunities again to meet your objectives. And then undercomplicate things. You know, when you're investing, there's so many different ways that you can invest into the markets. There's so many different people that will tell you about new investment strategies, about new investment ideas, or about something that you might not have exposure to. But if you keep things relatively simple, and that's not easy to do within the investment space, and think about the key building blocks that you're looking to achieve and how you want to be meeting your objectives, we think that again will send you a good practice to meeting your investment objectives. So then the how, we use judgment. We use a lot of sophisticated quantitative tools, but we know at the end of the day that we need to bring our own judgment experience to ensure that we're not just following a model and an outcome. Sound judgment often leads to better outcomes. Being humble is really important. Understanding that, you know, inherently we don't know what's going to be happening in markets over the next, let's say, 6 months. Forecasting is inevitably a very, very difficult thing. I don't know any economic forecaster that was telling us interest rates are going to be sitting at 5.5%, like they are in New Zealand with the Reserve Bank OCR rate sitting at 5.5%, mortgage rates up around 8%. No one was forecasting that 2 years ago. And that's a really important point. So you've got to be humble when you're thinking about market forecasts, when you're thinking about return expectations. Being reasonable, don't take extreme views. Often when people take an extreme view on a market, we find that they're often wrong. But again, the person is right that one time everyone listens to and expects them to be right again, and that's often not the case. Finally, action it. So when you make an investment decision to invest into a diversified portfolio, make sure you do that. You know, don't cut corners. Don't only do it half-baked. Allocate fully, implement it, and make sure you monitor it. So then other considerations that we think about when we're building portfolios. Certainly taking fees into account is really important. We spend a lot of time working with fund managers that we work with to get the best fee for our clients. That often leads to rebates flowing back into the ethical investing New Zealand clients. But also, we look at portfolios from a sustainability perspective. So it's a different view than just looking at the track record of the fund manager, the people within the fund manager, the organisation, the culture. You know, all funds that we use will have a responsible investment policy and integrate environmental, social, governance factors into the portfolio. And so we have started to look at the carbon exposure within client portfolios. And this chart here just shows how the ethical investment sustainable balance model and the sustainable impact balance model portfolio that we do the analysis on from a carbon perspective, how that stacks up relative to a standard portfolio that's only investing into broad market exposures without any exclusions or any carbon reduction. And so this is the way that we can making sure that we're providing transparency around the managers that we're selecting, that they meet the ethical investment, New Zealand's investment philosophy, the criteria about thinking about the environment, thinking about our carbon footprint, and making sure that the exposures that we have in the portfolios that we're recommending to them, that they're looking to use within their client portfolios, truly do stack up from a sustainability perspective as well. And you can get a lot of data now, and increasingly more and more data to come by companies which are having to provide data on the carbon intensity of their businesses, the carbon emissions profile of their businesses as well. We can use that in the reporting that we provide to Invest in New Zealand. We also look at fund manager exclusions. A lot of fund managers will sign up to the, so UNPRI stands for the United Nations Principles for Responsible Investing. So fund managers sign up for that. They're a member of the Responsible Investment Association of Australasia. Sorry, there's a lot of acronyms. That's RIA membership. Then do they integrate ESG into their process? Yes. And what exclusions do they have? So controversial weapons includes nuclear weapons. It can include cluster munitions, handguns as well. We also look at tobacco, fossil fuel exploration, fossil fuel power generation, alcohol, gambling, adult entertainment, firearms, human rights abuses. We've got a broad checklist that we look at all the fund managers, and we go through the policies and look at what they exclude. But not just that, we also look at we'd also try to dig a little bit deeper to truly understand how they think about exposure to fossil fuels in particular. Do they have a carbon reduction policy? Like one of the funds here, Russell Investments, where they've got a 50% carbon reduction. What type of threshold are they comfortable having within certain companies where they might have, through a subsidiary business, exposure to thermal coal, to oil, to gas, or nuclear weapons? So this is just really trying to dig into the detail that these fund managers provide us to get a good understanding of their policies and understand it's not always about just having zero exposure to coal, oil, or gas. They do have thresholds, they do have limits. What are they? What does that mean to our ability to recommend and invest into them? And you know, we provide this for a lot of the global equity funds that we invest into, and it's something that groups like Ethical Investing New Zealand are pushing us to do more of, because they want to make sure that they are investing funds that meet their investment philosophy and they adhere to the policies that they've developed when they're sitting down and working with clients as well, because we know this is a really important topic. And we want to make sure that we're doing our detail and our research on the underlying exposures within different fund managers as well. And we can get granular information going right down to the company level on all these funds as well to really dig into the ESG analysis. It's quite time consuming, but we've got some processes and systems about how we do it. Okay, so a quick market update from me, and then we can open it up for questions. So inflation's been a topic on everyone's mind over the last few years, and we've seen, you know, a period where inflation has been stubbornly high, sitting at times 6, 7, 8%. And, you know, that's why we've seen this dramatic increase in interest rates globally, going from certainly in New Zealand, Australia, and around the world, interest rates and mortgage rates. You know, interest rates sitting below 1%, mortgage rates sitting at what, you know, 3% or thereabouts, going up to cash rates up to 5.5%, and mortgage rates sitting at 8% now. It's all about combating inflation, because one of the key tools that the central banks around the world have to combat inflation is to raise interest rates and start to take some of the fuel that's driving inflation out of the markets. Now, Core inflation has been holding up a little bit more, but importantly, what we're seeing globally is inflation is starting to come down. It's starting to come down quite quickly as well. There's still some lingering data that's coming out that's showing that it's taking a little bit longer to come out of the system than people would like. That's why you're seeing the reserve banks and central banks around the world being cautious on their view. That's what we mean by hawkish. And we're seeing some pressure and impact on bonds and equities. But in general, short-term credit, a few areas within the alternative markets, but definitely your short-term fixed interest is now giving you a return of 5-6% on an annualized basis. So it's looking, to be a much better allocation within the portfolios and provide a really good return. And it's something we've not seen for many, many years. There's obviously a lot of macroeconomic risks at the moment around the world. So we're seeing economies largely avoiding recession. We've had, you'd say there's been a narrow, modest recession in New Zealand earlier this year. Australia's avoided it. The US has largely avoided a recession as well. So growth is slowing and higher interest rates are having an impact. But the economies are still growing, which is really important. The downside, though, is that we're seeing a greater level of macroeconomic risk. When you think about the outbreak of war between Israel and Hamas, obviously the Ukraine war and the ongoing concerns that we have here. And close to home, whilst business confidence is starting to bounce back following the election, we're expecting some relatively big cuts in government spending to flow through into the economy and be a drag on the growth rate with the New Zealand economy. And we've seen that again from a lot of global economic consultants that view that New Zealand might have a lower growth rate compared to other companies, also other countries in the OECD. But importantly, when we look at returns, we're still seeing some good, strong returns coming through from markets. And so this slide shows the 3-month return. Apologies for the siren. The 3-month return for various asset classes, and the green bar is the 1-year return for various asset classes. You can see, the last quarter was a difficult time for investing. We had, New Zealand equities off 5%, global property off 5%, global equities down 2.5%. But over the last 12 months, we've actually seen a really strong performance from global equity markets, in particular, sitting at 14 to 20%, really leading the way for the performance of a lot of different portfolios. So a little bit of volatility over the short term, certainly stronger returns over 1 year, especially within global equities. And I just want to finish on a couple of slides just to talk about how you want to be careful about trying to time the market and sell down an exposure because of concerns you might have about the New Zealand economy, about the global economy. And this slide just goes back to 1989, and it highlights, I guess, all the market and global geopolitical issues that we've had over that time, whether it be recessions, whether it be, financial crises such as the Asian financial crisis in 1997, the technology bubble in March 2000, the global financial crisis in 2008, COVID in 2020. And you can see this all had impacts on markets. We also had, other events, whether it be geopolitical issues, global macro issues. And invariably the market continues to go up. And so trying to time these areas is fine. Trying to decide when to sell out and then when to get back in is often really tricky. And what you'll notice with this chart is that the markets can rebound very, very quickly and recoup the losses that they've had. And we look at this going all the way back to going all the way back to 1928, we look at the US market and how it's performed over the very, very long term. And this is why people talk about holding the course, staying disciplined when markets go down, because invariably, when we look at the growth rates driving our economies, the growth rates driving the share markets, markets do trend up over time. And once you take away the short-term noise, the volatility, and you focus on the long-term, this is typically have a much better outcome. They typically have a much better chance of meeting investment objectives, and that's what this is all about. So, Peter, I'll finish there and see if we've got any questions from anyone.
We've got a couple of questions which have come through. One is, what is the difference between headline inflation and core inflation?
Sorry, very good question. And can you hear sirens in the back? I do apologise.
No, it's not too bad.
So they talk about so core inflation, and then we'll talk about it's more around things like services inflation. So when you think about core inflation, it's housing, it's food prices, I think it's labour wages as well, and that's all fine. And then services inflation is really the cost of goods of services where that you receive, and that could be going out, leisure services, so going out to restaurants, cafeterias, bars. It could be different activities that you do and the like as well, and that's where you've got a slightly disconnect between core inflation and petrol plays a big role in that as well, and then services inflation as well.
Cool, thank you. Related question: when you say after leverage and inflation, what does after leverage mean?
Yeah, sorry, that's after borrowing. So,
okay.
Key, when you think about people that have made money through property development, for example, they can leverage up or borrow a lot of money for a development, and that's where you can get a higher return than just the 10-12% that I mentioned before. But obviously, you're taking on a lot more risk once you start borrowing.
Right.
Taking individual borrowing into account.
Another question: are we making any changes to portfolios because of the Israel-Hamas war?
No, not at the moment. We do take geopolitical concerns into our consideration when we're making recommendations to clients, and we're looking at the impact it can have on portfolios. But we don't see any widespread conflict happening yet. It's really difficult once you think about geopolitical concerns, though, because obviously there's the US-China tensions at the moment. I mentioned the war in Ukraine as well, and invariably markets still continue, services still continue, and as difficult as it is. Around to want to do more, to want to think about trying to tilt the portfolios away from certain geographies or areas or certain types of companies. It's really, really much more difficult to do in the context of geopolitical issues, just because the world's so interconnected.
I think one of the things we always say to clients is that, regardless of what's happening in the world, people still need to buy things, they need to get groceries, they want to connect with loved ones and travel and so on. So those basic human needs and desires carry on. And slightly different question: what's your thoughts around the level of debt in the US? Because it keeps on rising, and the ongoing risks of shutdowns, because every 5 minutes it seems to be they reach a crisis, but they always seem to work their way through. So what's your thoughts?
So, countries around the world globally have got quite a lot of debt, and part of it is COVID, and so the amount of debt that companies took on as a result of COVID. But even beforehand, we're already seeing some pretty high levels of debt as well. Apologies, I've really got. I don't know what all the sirens are around the CBD at the moment, but there's quite a few happening outside our window, it seems. So the level of debt in the US is definitely a concern. They've continued to raise it. They continue to hit with the debt ceiling, so that the maximum allowable level of debt that the government or Congress have decided, and that's in law. So they've got to go to raise that debt ceiling. They've got to go to Congress, and they've got to ask them to actually increase the amount of debt they can have in the US. And so that's a concern, because essentially what they're doing is they're funding projects for today by borrowing from tomorrow, and leaving that issue for future generations to sort out. When you look in the past, when you look at high levels of debt, we can go back to looking after World War II, for example, where countries all around the world had a significant amount of debt. There's different ways you can combat it. You can grow. So if you have a strong growth rate, you can pay down that debt quickly, or certainly pay it down over time, and get yourself into a much better financial position. Or you can cut costs and look to have to pay down debt by offering less services as a country as well. Obviously, the second part is something that most countries are looking to avoid. They're looking to try to stimulate their economies, have a higher growth rate, earn more money so they can pay back more debt. But it's not an easy situation. What countries like the US have in their favour is they've got a currency in their favour. And if things are really difficult in the US, you'll find the US dollar will fall in value, which means that the debt that they have could be worth less. So there's different ways where people talk about having their own currency can also help to, have an influence on how much debt they're paying back to. We'll get a little bit more technical there, but it's certainly a factor. So it's worrying, but it's manageable at the moment, and I think it's something that we need to be cautious of globally.
Thanks. How much further do you think interest rates will go?
That's a really great question that's very difficult to answer. Our view has been that you might not see interest rates go up too much further from here. Certainly, central banks around the world are talking about, what we're hearing from Reserve Bank of New Zealand in particular is that they're pausing for now to let the impacts of the rate increases they've put in place, let them really flow through. And, there's a lot of evidence to say that rate increases can take, 3 to 9 months to actually flow through into the real economy and have an impact. And so that's what we're seeing from our central bank at the moment. I think it would be unlikely to see rates go too much further high. You might see, another 0.5% higher from here, but much further than that, I think would be very unlikely, especially if we see less government spending coming through from the National Party. That's also going to have that will also impact the amount of the interest rates need to go up. Our view is that interest rates might stay higher for longer, though. A lot of people were talking about interest rates starting to come down early next year. That appears unlikely.
Okay. Slightly different subject, one that's really topical. My daughter's school, this is not me, this is obviously one of the viewers. My daughter's school is talking about students using AI for homework. How do you see AI impacting the investing landscape?
Yeah, so this is the year of AI where we were talking about it and looking at. I think we're talking about it from a high level about what AI was and what it could do, and some of the new tools that have been rolled out across the internet over the last 3 to 6 months. Have really provided AI for the masses, and you've got ChatGPT and different things where people can ask questions and get an algorithm to actually write an essay, provide an answer, do homework for them. I actually think it's really positive in many ways because it should help with productivity, and I think productivity within organisations is really something that people are doing manual tasks too often, and if you can think about ways you can use the AI to have more automation within companies. I don't think at the moment it's going to take away jobs, but it might have an impact on reducing the cost of different services. And if you even just think about if you're buying a home and you've got to go and get all the legal documents needed, how much money you spend on that, if that could be something that is commoditized through AI, then that would be really powerful. But that would be a negative for lawyers. So there's definitely going to be winners and losers from this, but in general, I actually think it's going to be more winners from investing. The one important point is that we always see trends and we always see fads come through within investing, whether it be, a few years ago, everyone was talking about disruptive innovation within technology. And maybe AI is a part of that. But when it comes down to investing, trying to follow these trends and try to monetize them and profit from them, it's often the later adopters that actually do much better. And we saw that during late 1990s when the first true technology bubble and the internet was launched, and these companies had these incredible returns for a couple of years. And we've seen this with Bitcoin as well and other digital coins, where there's a lot of hype, returns go up really, really strongly, and then people realize there's actually not the strong fundamentals behind them just yet. And it takes a while for that to flow through. So from an investment perspective, we're seeing a lot of companies take advantage of AI, but it's not a thematic that I think you should just adopt and invest into, because I think it's much broader than that.
That fits in with a couple of interesting articles I was reading from The Economist earlier this year, comparing and contrasting the US and China. The one on the US said AI could add 1% a year to their growth, and therefore presumably markets, investing and so on. But conversely, that maybe China has reached peak China in terms of its economic growth in the world. Just wondering what you're picking up and seeing.
Yeah, well, when you think about large manufacturers, AI and the automation that they'll be able to do, should make those processes less human intervention. And so I can see how that would have an impact on places like China, where they're literally the manufacturing hub of the world, or the factory for the world. But again, I think these things will take time, and I think economies have got time to pivot as well, and to move people into different industries. There's some really fascinating topics when you look at the types of jobs that we have today and how different that is to what we had 30, 40 years ago. And you do see jobs in the evolution changing from much more service-oriented jobs now, from manufacturing jobs and the like. And I think we might be going through another change with AI, but again, it will take some time to have a true impact.
Hopefully won't affect either you or us. Going to a slightly different topic around the whole ethical investing area, are you seeing any new trends starting to filter through from people looking at investing to make a positive difference as compared to the older, avoiding the usual nasties?
Yeah, so I think that's a really good question. And that's the one thing that, when we're thinking about investing from an ethical standpoint, we've started off with just excluding. So just saying, I don't want to invest into these parts of the market, whether it be alcohol, tobacco, fossil fuels, nuclear weapons, the like. But the more interesting part is thinking about how do we tilt towards companies that are doing good. And we are starting to see some new initiatives come into play. Social housing is a really big area of investment at the moment, not just for the government. There's a number of foundations, charities, and different groups that are putting a lot of onus into this area and partnering up with established building providers and developers. And I think that's a real positive, and you can actually earn a solid return from that. A return probably a little bit more than what you get from a term deposit in the bank, so it's more of a defensive fixed interest like return. But things like social housing, I think it's really interesting, and we're seeing a lot more of that come through. we're also seeing a big focus on renewable energy as well. So companies investing into, new battery technology, new ways to think about charging, solar panels and the like as well. I think that's, that's also a really interesting space to be thinking about, and a lot of investors are seeing a good return opportunity from those parts of the market as well. And then climate, just in general, you're thinking about people who are providing some, a service or a product that's good for the climate. That's global, and even where you've got different countries or places where there might be some pushback about environmental investing, social governance, and the like, you're just seeing innovation really driving a lot of really interesting options, and again, we've got to think about whether or not they're sustainable investments, and look at them on their own case. But there's some really interesting strategies to invest in there as well.
So a sort of follow-up question to that is, obviously there's been a whole flood of new ethical investment funds the last year or so in particular. We keep getting asked by new providers or new funds to market. You're obviously getting the same. So obviously if you're looking at funds that might possibly come into the portfolios you give to us, if there's a new fund out, there's obviously got to displace an existing one.
Yeah.
So how do you actually decide when it's time to recommend to us that the portfolios might replace or partly replace one fund with another?
Yeah, and I think in general, that's, for me, one of the first things that we do within any product that we're looking into is we think about the role it plays in the portfolio. And so you might be a genuinely interesting option, but if it's, just investing into startup, climate-related investment opportunities, we know invariably that's going to be a really volatile return path, and could be a difficult one for people to be able to stomach. We're also trying to dig into culturally the firms that come to us as well, and why are they focused on ethical and sustainable investing? Is it just a new product option for them, or is it something they really believe in? And so we actually talk about environmental, social governance, and cultural factors when we're looking at different fund managers and investments as well. Having a fair degree of cynicism is really important, Peter. You've seen a lot of different fund managers as well. Everyone will come to you with really slick marketing documents, a really impressive sales approach. But the numbers don't hide any. You can't hide behind the number. You can't hide the numbers though. So we spend a lot of time looking at the data, looking at the portfolios, making sure it stacks up. And I think we're cautious about just switching and flipping between different investments. But what we like to see, and what we're seeing invariably, is the managers that you're using in your portfolios, that we've got research on, they're not standing still either. They're always looking to improve their processes, to improve the level of reporting, to think about the impacts that their investments are having on communities as well. And so that's important as well, because I think if you start to see the incumbents stand still, then you'll definitely see opportunities for others to come in. But there's always some interesting managers to look at. That's the fun part of the job for sure.
Yep, that's certainly true from our perspective. That's probably a good point to actually finish the webinar. We certainly as a firm really appreciate you and your team's help, Chris, in terms of doing a lot of this hard grunt work behind the scenes. We're much better placed going out and actually spending time with our clients than trying to do all the endless research that you and the team do so well. So we'll conclude the webinar now. I'd just like to say thank you very much for sharing what you and the team do. Hopefully viewers of this will find that a great peek under the hood, so to speak. And we look forward to working with MyFiduciary for a long time to come. Thanks very much for that presentation. Thanks to all of you out there for viewing this. This is the last presentation for this year. If you've got any suggested topics you'd like us to cover next year, please let us know. And for now, that's it from us. Thank you.